What if the pin that finally pricked the everything bubble wasn't some dramatic headline on CNBC, but a quiet shift that's been building for years, one that only becomes obvious after the first cracks start running through the glass? What if we've already crossed that line, and the gold market, rising against the grain, stubborn, relentless, is telling us something the rest of the world is just now beginning to hear? If you felt the tension in your gut each time the market rallied on bad news, each time deficits ballooned while yields fell, each time the hamster wheel spun faster without actually getting anywhere, then you know what I mean. This is the moment where the math meets reality, where the story finally catches up to the numbers, where the surface calm can't contain what's happening beneath. And yes, gold is moving, not because of panic, but because the system is repricing risk. Let's start with a simple truth that doesn't require opinion. Every bubble ends. The only open question is what breaks first: price, liquidity, or confidence. The everything bubble, unlike .com in 2000 or housing in 2006, wasn't isolated to one corner. It was real estate at new highs despite affordability at record lows. It was stocks trading at valuations that assumed a frictionless future. It was bonds where trillions of dollars of sovereign debt didn't even pretend to compensate for risk. And it was the shadow layer beneath that: derivatives, leverage, and funding markets stitching the whole thing together. When real yields are artificially low, the present gets overvalued and the future gets discounted to zero. That's not conjecture. That's how discounted cash flow math works. And when the discount rate moves, everything reprices. Slowly at first, then suddenly. So why is gold rising now? Because gold has never been about growth or earnings or dividends. It's about trust, the ultimate trade when credit becomes opaque and narratives turn mushy. It's not that gold predicts a crash every time it rises. It signals a change in the regime, and you can see that regime change in the flows. Western ETFs can be bleeding ounces while the price climbs, because the marginal buyer isn't the retail investor in California. It's a central bank in Asia. It's a sovereign wealth fund reallocating out of treasuries at the margin. It's a commercial desk quietly reducing short exposure on paper futures while sourcing physical bars with longer settlement windows. Price is a negotiation between two worlds: the leveraged paper world that prefers convenience, and the physical world that insists on finality. Watch the fingerprints in real time. You might see a spike in Shanghai premiums, local spot price trading above London spot, meaning physical buyers in China are willing to pay more to secure metal. You might see Swiss refiners reporting bigger flows of kilobars heading east. You might see GLD, the big Western ETF, drifting slightly lower in holdings even while prices firm, meaning the engine underneath is shifting. That's not a bubble bursting in gold. That's demand professionalizing and decentralizing. In a way, it's the opposite of a blow-off top. It's quiet accumulation. And it's happening while the everything bubble shifts from asset inflation to credit deflation in slow motion. On the technical side, the picture tells a story of a multi-year coil finally releasing. Think back to the prior highs, those 2011 peaks that haunted gold for years, that double top that repelled every rally. Then consider the breakout behavior over the last few years. Successive higher lows on weekly charts, consolidations that got shorter in time, pullbacks that found support at rising moving averages. If you were watching the monthly candles, you saw something that looks like a long cup and handle formation resolving to the upside. In market structure terms, resistance becomes memory, old sellers become new buyers, and once price establishes acceptance above that old range, call it the zone where the 2011 top once lived, what was resistance becomes a floor. The key levels aren't mystic. They're areas where supply tried and failed to absorb demand. When those levels flip, the path of least resistance is higher. But price doesn't move in a straight line. Momentum signals hiccup, trend support retests, and every dip feels like the end for those who lived through choppy ranges. That's why the weekly 20 and 50 period moving averages matter. That's why the RSI failing to break down on sell-offs matters. That's why you look for trend confirmation in the minors. If GDX or GDXJ start outperforming spot gold, if the HUI to gold ratio stops making new lows, it's often a tell that capital is positioning for a sustained move rather than a speculative pop. Professional capital likes liquidity, which means miners get attention late in the move, but the early hints come from the way they hold up during stress. The miners are notoriously volatile. When they stop breaking on bad tape, it's usually not random. Now layer in fundamentals. Gold isn't needed to justify the move. Fundamentals are merely the scaffolding, but it's helpful to understand the pressure points. Start with the math of the sovereign and the corporate borrower. Debt is a claim on the future, but interest is a claim on the present. When interest expense eats a bigger slice of the budget, the system needs either more growth, more inflation, or more financial repression. If you can't print productivity, you print nominal growth. If you can't sell bonds at yields you can afford, you intervene, term premiums collapse, or liquidity windows reopen with clean labels. Call it QE or bank funding programs or temporary facilities, it's really a vote that the bond market cannot be left to run free. And that vote is bullish for gold, not because gold yields anything, but because it's the one asset that doesn't depend on anyone's promise to pay. Then consider the central banks themselves. Quietly, methodically, they've become the most important buyers in the market. It isn't new, but it's more focused now. Some did it for reserve diversification, some for sanction proofing, some as a long-term hedge against persistent deficits in the West. Pick your motive. The behavior converges. You're seeing a world that took note when reserves were frozen with a keystroke, when a currency became a weapon, when risk-free turned political. That's not a moral judgment. It's a portfolio decision. If you run a central bank in an economy that trades a lot with non-Western counterparts, what's your safest store of value that isn't someone else's liability? The answer isn't crypto, not for a central bank. The answer is gold. This is why the everything bubble popping doesn't mean everything crashes at once. It means cross-asset correlations change. Stocks can bounce, bonds can rally, real estate can stall, and yet the deeper current moves in one direction, toward assets that don't need the old rules to survive. And gold isn't moving alone. Silver wakes up late in the cycle, but moves harder when it goes. In bull phases, the gold-to-silver ratio compresses, 110 down to 80, 80 down to 65. When that ratio dives, it's usually not mere speculation. It's a reflection of tightening physical markets and increased industrial hedging. Silver's dual identity, monetary and industrial, makes it an amplifier. If supply is constrained and capital rotates into hard assets, silver's beta does the talking. Consider the COMEX and LBMA machinery, not as conspiracy, but as plumbing. Futures exist to hedge, not just to speculate. Banks, miners, refiners, and industrial users need price certainty. They lay off risk. That creates a vast network of paper claims whose notional size can dwarf what's deliverable at any given moment. Most of the time, it works beautifully. But in tight physical markets, a little friction becomes a lot of drama. Backwardation, where near-month futures trade above far-out months, can signal a rush for immediate metal. SGE and LBMA price divergences can indicate bottlenecks or capital controls affecting flows. Even lease rates, the price to borrow gold, tell you when metal in the right place at the right time is getting scarce. And when the eligible to registered inventory ratios on COMEX shift enough, you find out how much optionality is actually in the system. Don't think of this as fragility. Think of it as an honest signal. Physical demand dictates final settlement. Paper only travels so far. Now, zoom out to the macro regime. For a decade plus, the default trade was duration. Own anything that benefits from falling rates and a steady liquidity drip. That powered the everything bubble and made risk managers look like heroes while VAR models grew complacent. But regime shifts are sneaky. You don't wake up one day with a headline saying, "Welcome to the new era." You notice that bad data doesn't take stocks down. You notice that yields fall without a recession call. You notice that the dollar gets soft even when nominal yields are elevated. You notice the policy narrative drifting from inflation fighting to financial stability, from higher for longer to carefully calibrated. Then you notice gold starting to behave like the North Star again, quietly anchoring portfolios while everything else negotiates. History doesn't repeat. It rhymes in inconvenient keys. In 1971, when convertibility ended, it wasn't just a policy move. It was an explicit declaration that the old contract had expired. Price took years to digest that. By 1980, under Volcker, gold peaked not because the story died, but because the cost of money suddenly had credibility. Real yields ran high, and discipline returned, brutally so. But every cycle since then has needed progressively more leverage to create the same unit of growth. In 2008, the system cracked, and the response was extraordinary. Gold rallied not only because people were scared, but because the remedy, expanding central bank balance sheets, reframed what money meant. In 2011, as Europe trembled and the US lost its AAA status, gold's spike was a referendum on policy. It didn't end the game. It marked a chapter break. The next chapters included taper tantrums, the dollar's revival, and a consolidation that lasted long enough to make most people forget gold ever had a starring role. If the everything bubble has truly popped, this isn't a replay of 2008 where mortgages were the villain and banks wore the mask. It's broader and subtler. It's the cumulative effect of debt dynamics intersecting with demographic drag, geopolitical realignment, and technological deflation that can't rescue balance sheets. The result is fiscal dominance, policy shaped primarily by the need to finance the state rather than to optimize growth. In that world, real assets aren't a trade. They're a hedge against creative policy solutions. If nominal GDP must remain high to manage debt loads, if inflation must be tolerated above target now and then, if yield curves are guided, then the repricing of gold is a feature, not a bug. But let's make it tangible. Imagine a portfolio manager in London who has spent the last decade buying the dips in tech, extending duration whenever the narrative softened, and selling vol because it paid the rent. Over the last year, he notices something unnerving. His bond hedge doesn't offset equity pain like it used to. His real estate exposure looks fine on paper, but refinancing risk keeps creeping closer as the calendar turns. His clients don't want to hear about macro. They want returns. He can't buy private credit at scale without loading up on liquidity risk, and he can't sit in cash with inflation still hammering real returns. What's the rational move at the margin? A hard asset allocation that doesn't rely on anyone else's promise. Not an all-in bet, just enough not to be naked. At the same time, envision a central bank reserve manager in Asia. Their playbook changed in 2022 when reserves were frozen on political grounds. Not because they had chosen a side, but because the map of risk redrew itself. Suddenly, diversification wasn't about adding more currencies, it was about adding neutrality. Every month, a steady clip of gold purchases, some disclosed, some not. Every quarter, a reassessment of reserve composition with an eye toward settlement resilience. Do they care if Western ETFs are selling? Not particularly. They have their own custody arrangements, their own refiner relationships, their own view of time. That's the buyer shaping the floor. Layer in the retail investor in India who buys grams at a time, the refinery in Switzerland that's running additional shifts to meet kilobar demand, the miner hedging less aggressively because forward prices don't compensate for the optionality they're giving away, the jeweler in Turkey who sees demand spike with currency weakness, the commercial hedger in the US who's carefully shifting positioning. Individually, none of these stories move price. Together, they're the tide. Now I can hear the pushback from the "this time is different" camp. What if rates keep falling and risk assets rip? What if inflation vanishes and we return to the old normal? Even then, gold isn't a casualty. In 2019, real yields fell, equities partied, and gold rallied anyway. Why? Because the market priced in the policy response to slowing growth, which meant easing, which meant the floor under gold lifted. Gold is not a doom trade. It's a regime trade. In a world of chronic deficits, politicized trade, and balance sheets doing heavy lifting, gold has a higher equilibrium price than in a world of hard money and fiscal discipline. The argument isn't apocalyptic. It's arithmetic. Let's talk risk management, the quiet part investors rarely acknowledge in public. Gold's role isn't just about return. It's about reducing the probability of ruin. When portfolios break, they don't break gradually. They gap. Correlations go to 1, liquidity disappears, and the assets you thought were uncorrelated reveal they were just temporarily independent. In those moments, the demand for collateral you can actually deliver goes vertical. That's when gold's most boring feature, final settlement without counterparty, becomes its superpower. You don't need to sell gold in a panic for it to protect you. Its mere presence changes the trajectory of forced selling elsewhere. A quick note on miners, because they can either delight or destroy. They are operationally leveraged to gold. Costs are sticky, revenue floats. When the tape wants to re-rate gold, miners can look like rockets. And when it wants to punish anything with operating risk, they can fall through floors. The edge is in understanding when margins will expand. Energy costs matter, grades matter, jurisdiction matters. If the market believes the move in gold is durable, it will pay for future ounces, not just current ones. That's when explorers and developers wake up. But be careful. In early cycles, the market loves optionality. In later cycles, it demands discipline. If this is the start of a sustained repricing, not a spike, the next phase is about quality, balance sheet strength, cost control, permitting visibility, and insider alignment. We also need to talk about the reality that paper gold still sets the price most days. That's not a conspiracy, it's liquidity. But in periods like this, the physical tail does wag the paper dog. You see it in delivery requests creeping up into month end. You see it in time spreads behaving oddly. You see it in premiums in one geography refusing to mean revert. This is not guaranteed to lead to a dramatic break. More often, it leads to gradual structural changes. Banks pull back from market making in unallocated positions. Basel III rules make holding certain exposures more expensive, and the system adapts by increasing the share of fully backed claims. That's healthy. It makes the market more honest and the price more reflective of reality. Let's pause for a practical aside because I know many of you are thinking about personal exposure rather than trading desks. If you're sitting on $100,000 or more in retirement accounts and wondering how to protect purchasing power without triggering tax headaches, I put together a straightforward guide on how gold IRAs work. It's in the description. It walks through how people get allocated to physical metals inside retirement accounts, the rollover mechanics, and the fees to watch. It's purely educational, and it'll help you decide if that route makes sense for your situation. If it doesn't, no problem. There are other ways to build a hard asset sleeve. Anyway, let's get back to what the price action is signaling next. So, where does this go? A breakout isn't the destination. It's the departure point. The market will test conviction. It always does. That means a pullback that feels too sharp, a headline that spooks weak hands, a month or two where nothing happens and bears declare victory. In structurally bullish regimes, the big tell is that corrections fail to break the trend. Watch for higher lows on weekly closes. Watch the behavior around prior breakout levels. Do we retest and hold? Watch the USD. Gold doesn't need the dollar to fall to rise, but a softening dollar removes friction. Watch real yields. If growth slows faster than inflation, real yields compress, and gold doesn't need anyone's permission. And watch the cross currents in physical markets, premiums, lease rates, and refinery utilization. For those looking at silver, expect the mess before the glory. It will overreact, underperform when you need it most, and then steal the show when you've stopped looking. If the gold to silver ratio breaks lower decisively after years of high territory, that's your cue that the monetary metal's little brother is waking up. Producers will hedge into strength, which can cap moves temporarily. But once industrial demand and investment demand overlap, the acceleration can feel disorienting. Silver is not for the faint of heart, but it's honest. When liquidity wants metals, silver stops asking permission. We also need to sit with the uncomfortable truth that policy will not just observe this from the sidelines. When the everything bubble deflates, policy tools evolve. We've seen yield curve control elsewhere. We've seen bank funding facilities that look a lot like quantitative easing with a different haircut schedule. We've seen fiscal transfers disguised as supply-side reform. The labels don't matter. The effect does. It means nominal activity can appear healthy while the currency quietly does some of the adjustment work. That's not a crime. It's a preference. In that world, gold doesn't need a crisis to rise. It simply needs time and a steady erosion of real fiat returns. Think also about the employment of capital at the household level. If housing affordability stays constrained, if credit cards carry APRs that feel predatory, if student loans reattach themselves to budgets, what happens? People move from speculative behavior to defensive positioning. They still want participation in growth. They aren't going to bury cash in the backyard, but they want ballast. That's the role gold plays for individuals the same way it does for central banks. It's not an opinion hedge, it's an operational hedge. It gives you time to make better decisions when the tape stops cooperating. Now, a word on narratives that will attempt to dismiss the move. You'll hear that gold is an old man's asset, that it doesn't produce cash flows, that Bitcoin is the better store of value. Set aside the tribalism and focus on portfolios. Stores of value serve different roles for different constituents. For a sovereign, final settlement without political risk matters more than network effects. For a corporation, balance sheet management depends on liquidity in fiat terms. For an individual, volatility tolerance and time horizon dictate everything. Nothing says you can't own multiple hard assets. The issue isn't which tribe is smarter, it's whether you've matched the tool to the job. If the job is hedging fiscal dominance and policy flexibility, gold is not obsolete. If anything, it's more relevant because the institutions that move markets are treating it that way. Back to market signals. Keep an eye on the way gold behaves on days when everything else is green. In weak hands, gold sells off to fund other trades. In strong hands, gold holds firm or even rallies as a portfolio weight. That rotation tells you who owns it and why. If rallies in tech don't pressure gold, it suggests the buyer base is different this time, Less speculative, more strategic. Also watch for miners raising equity into strength. It's normal, but the quality of those raises matters. Are they funding productive expansion or plugging balance sheet holes? Look at insider buying. Talk is cheap, but wallets tell the truth. On the supply side, nothing about bringing new ounces to market is easy. Discoveries are rarer, grades are often lower, permitting is slower, and ESG requirements are more demanding. That's good for long-term pricing, even if it complicates investment selection. Recycling will flex, but recycled supply follows price with a lag and rarely smooths big cyclical swings. Meanwhile, long-term contracts from central banks and institutions constrain available float. Don't underestimate how much a slightly tighter physical market can reshape the futures curve. If borrowing metal becomes more expensive or slower, the convenience yield rises, and the nearby contracts reflect that urgency. There's a temptation to treat this moment as a one-way street. Don't do it. The right mindset is dynamic. If we get a genuine deflation scare, growth rolls over hard, credit seizes, unemployment spikes, gold can dip with everything else initially as investors raise cash. That's the liquidity effect. But structurally, such a scare only increases the probability of policy response, which in turn supports gold. The playbook is: be patient, add on fear, and measure your time horizon in years, not weeks. Trading around a core position is fine if you're nimble. If you're not, let the big trend do the heavy lifting. Here's the uncomfortable but clarifying framework that has served disciplined investors well. Stop asking what you want to be true and start measuring what is true. What is true is that deficits are not shrinking sustainably. What is true is that global trade patterns are moving toward redundancy and resilience, not maximal efficiency. What is true is that the cost of capital cannot return to the zero era without consequences somewhere else. What is true is that the marginal reserve manager values neutrality more than yield. What is true is that populations are aging in developed markets, and entitlement promises aren't shrinking. What is true is that optionality has a price, and gold's option doesn't expire. Think back to moments when people dismissed gold. In 2013, when taper talk sent it into a brutal bear market, it wasn't just falling. It was capitulating to a world that believed rates could rise without stress, that believed balance sheets would shrink, that believed supply chains would heal and geopolitics would quiet. None of that turned out absurd. Some of it even occurred for a while. But time brought stress returns. And through all of that, central banks bought. The strongest hands at the longest time horizons leaned into the trade most Western speculators had abandoned. It's not because central banks are always right. It's because their mandate is survival, not performance. If the everything bubble is indeed unwinding, you'll see a new market etiquette emerge. Buying dips will still work, but in different assets. Leverage will still be used, but more carefully. The winners will be those who manage cash flow and duration with brutal honesty. And underneath it all, you'll see a recalibration of collateral, what the system trusts when the noise gets loud. In that recalibration, gold is not the loudest voice, it's the tuning fork. When price rises while volatility remains contained, that's the signature of accumulation, not mania. When miners rally but insiders still buy, that's the signature of patience, not euphoria. When premiums in physical markets refuse to collapse even as paper positions churn, that's the signature of constraint, not exuberance. What if this is only the first act? What if the repricing in gold is just catching up to the repricing in everything else? Then the risks of waiting are not that you miss the next 2% move. It's that you arrive after the base has already been laid, after the institutions have already done their bids, after the structural players have already hedged. This is why the magnitude of the move matters less than the character of the move. Are sell-offs shallow? Do trend lines hold? Do dips get bought by new money, not just the same tourists? Are the narratives explaining weakness getting weaker? Are the narratives explaining strength getting more coherent? These are the rhythm sections of a sustainable bull. The last piece is human. People hold on to narratives not because they're useful, but because they're familiar. We're wired to prefer solutions that worked yesterday. The everything bubble trained an entire generation to ride duration and to trust backstops. There's nothing immoral about that. It was rational in that era. But when eras change, the cost of nostalgia goes up. You don't need to throw away the old playbook. You need to add pages. Gold is one of those pages. It's not a cult. It's not an ideology. It's a recognition that cycles exist, that regimes change, and that portfolios should be robust to the change, not optimized only for the past. So where does that leave us?